Valuers are a very important part of this process. It might be if an investor or buyer is looking to purchase a property, they'll first engage a valuer in that process to go and independently have a look at that property for the buyer. It can also work at the other side. When they're selling, they want to get another view, an independent view from the agent. So they'll go and they'll do the research on behalf of the vendor and say, look, this is the price, the reserve that you should set before the auction. But valuers are used for a whole range of issues, and particularly in a statutory sense. Whenever you go and get a mortgage, a bank will send out a valuer to independently assess the value of that security before they lend on it. So they use the valuers to be their eyes and ears in the marketplace. They assess risk on behalf of the bank, and so that they can lend money with a degree of security. So we all of us who own residential property, or any property for that matter, also get a rate certificate, and it's the valuer that does that work, who assesses the site value, assesses the capital improved value for which your rates are assessed. The other reasons to use the valuers in the marketplace is for insurance. We find that too often properties are underinsured, or they might be overinsured, because very rarely is a valuer used to assess insurance. If there's a dispute mechanism, if somebody's getting divorced, if there's a partnership breakdown, it's also the valuers are used in that process as well, in order to assess the value so that it can be split amicably. Well, valuers are the expert in the marketplace, so it's really important to engage a valuer very early on before you make an investment choice. We know what works and we know what doesn't work. We tend to avoid putting our investors into main road locations, for example. We try to really focus on the scarcity of the property, because they're the sort of things that really prove to enhance capital growth. We generally won't buy off the plan, because we want to see a proven history of performance in capital growth. Buying a property simply for income growth or for taxation purposes, those sort of reasons are generally not a good reason to buy property. We like to look at properties that are tried and tested in the marketplace, that have shown a 15 to 20 year history of good growth potential, because past history is often a good indicator that those types of properties are going to perform into the future. It shouldn't be any different at all, because when a valuer does a valuation, it's based on sales that are gathered into the marketplace. So typically we'll value a property at number 1 Smith Street. The valuer will then look at other sales that have occurred in Smith Street. It'll look at sales that have occurred in the adjoining streets, and it might even look at the history of that particular property selling as well. So whatever valuation that the valuer arrives at, it must be based on past sales evidence. So there should not be really any difference between market value and a valuation. Well, I'll look at a number of things, and certainly start with the architectural style of the particular dwelling. I'll look at the land size, I'll look at the building size, I'll look at its position in the street, I'll look at its orientation, I'll look at its floor plan, its layout, and I'll look at its proximity in terms of being able to walk to a school or walk to cafes, public transport, and that sort of thing. It's also important the surrounding properties and landscape. If it's right next door to a house, is right next door to a block of flats, or it's next to a commercial precinct, it might not be such a good thing. But generally, it's a combination of all of those factors